beginning of 25, I said 2025 is the golden age of grift. And when I said that, I had some friends over. Some friends were telling me, I thought when you said it, you were exaggerating, but now I think you were being a bit too conservative. It's so much worse. Good morning. How are you, gents?
Good afternoon for us. Good morning to you.
We are going well, mate. Appreciate you jumping on at such short notice, mate. Excited to
I missed you guys. I've been feeling like we had to do this. It's been a while.
Yeah. How's things on your end, mate? How's life been?
Fantastic. It's been fantastic.
And
you know what? I'm actually loving that we're doing this. I'll mention it on the call anyway. But we always do this at a turning point. So I'm just glad we're doing it now.
What was our turning point last time?
Dude, last time we were basically... I was invited during like a really bad moment in miners where everyone was depressed. And I was telling you guys, I spoke to everyone in mining and they were all so depressed that I just went out and I bought like Glencore, Anglo and all that shit.
Yes.
And then a few days later, the Chinese came out with like a stimulus plan.
I remember that. I also remember there was like peak.
And I was like, and I told you, by the way, at the time, I was like, I'm so glad we're doing this because everyone is so depressed in mining. I think it's a good time to be buying all these things.
Yes.
So,
what was the? I feel like you were toying around with buying SBSW puts. Coals as well, and Calvin was like projecting that the end of the world was happening for SBSW, but meanwhile he was loading.
That was it.
He was loading up on coals as well. He nailed it, by the way. I think he manifested a bottom.
I was buying platinum as well, so I was like bullish platinum, bullish miners, buying all those things.
The Shrub. It's an age of debasement because grift brings debasement. Simple as that. It is kind of simple when you say it like that.
Keep it simple, Shrub. Kiss.
You never cease to make us laugh and reflect on, I think, just like the state of the macro world in such like a simple but funny way. I thought that one sentence, that phrase is just, it's perfect. Of course, grift brings debasement. Like it's so simple when you think about it. Of course.
Throughout the ages, throughout the millennia, that's the way it was. And, we live in the golden age of grift. It's quite funny. Like when I coined the phrase, I said like 2024. In 2024, I said that's going to be the year of Tamagotchi Yellen because, Yellen just drove the whole market. And then in beginning of 25, I said 2025 is the golden age of grift. And when I said that, I had some friends over. Some friends were telling me, I thought when you said it, you were exaggerating, but now I think you were being a bit too conservative. It's so much worse. So fast forward like 8 months later, it is so much worse. And I think that's where a lot of people got blindsided that, we are characterized by grift. And like you said, currency debasement is an obvious feature of the golden age of grift. Like this is what happened during the Roman times when, they were chopping off bits from the silver coins, that was a element of grift, right? And that was the first case of currency debasement. And this is where we are. Like currency debasement just suits everyone and it's a key feature. And a lot of people are going to be trying to be contrarian and say that's not going to keep going. But man, it is a feature. It's very, very tough to bet against it.
It's a pretty long dated feature what you're talking about there, but it's also not, right? Like what we're talking about is, in the space of 8 months, it's so noticeable. So how do you think about it sort of playing out in timescales?
Yeah, look, I think in this one case, bear in mind, like I've lived through debasement because I grew up in Cyprus and Greece. So back before before the euro. So I remember vividly when things would cost like 300 drachmas, and a few years later they would be costing like 1,000 drachmas. But those places were more emerging market, so there were consequences that were felt immediately. Like we had a socialist government for a long time, and then that got replaced by a right-wing government to fix things, and then that brought the euro. So it brought some stability there. Which, by the way, the euro brought deflation by itself. And with the consequences of Brexit and the European crisis. But in this case, it's actually way worse in what way? The US is the reserve currency. So, like you said, it's a longer time frame that we're playing for. And even there, we felt it noticeably in 1 year. But because it's the reserve currency, they can get away with a lot of things in the meantime. And they can also be arrogant enough not to halt it. And I think that's the key thing that is missed by quite a few, is that, if the administration believes in American exceptionalism, like the previous one, by the way, because let's not, I'm an equal opportunities Shrub. I just make a parody of both administrations, just so we're clear. I think the previous guys were actually worse than the current guys because they were covert about it, and they were just printing to get reelected. And now the current guys are kind of like they actually tried not to print, and for a few brief moments in time, Main Street was winning against Wall Street for like 6 days when they said, oh, we actually have to, rein in on the US debt. We have to rein in this currency debasement. But it lasted about 6 days. And then they just gave up and said, well, actually, can't really do that. We're going to have to run it hot, which is effectively like currency debasement. So how this plays out, it's just going to keep going until something breaks. And I don't know what breaks. I don't know if it's going to be the bond market that shakes them, or if it's going to be the currency. I mean, look, the currency has been in a steady. I've been a dollar bear for like the last year since the inauguration, and now it feels like very consensus. I know it, and I wouldn't be surprised if the dollar actually just stays here. But I think the next phase is a global debasement. So not the dollar going to like 140 with the euro. It's just kind of like everything getting debased. And I think that's going to be a feature again of the next, like you said, it's going to be like a long feature of the situation because, there's so many macro elements to it. There is a reshoring, there is creating new alliances. There's still like supply disruption. So all these things are like require money to be spent. There's no way about it. So you look forward in the future. Are we going to have like a new Thatcher? Are we going to have like a new Volcker? I mean, let's just reflect on the last meeting, the last Fed meeting. We didn't have a Volcker. We had, one guy dissenting for 50 bips, which was Steve Miran. And then we had everyone else, pretending that they did an insurance cut, but actually, they all want to cut more in reality. So it's this thing about the Fed being hawkish or dovish. Now the Fed is rarely hawkish. I mean, they were hawkish in 2022 after they blew up, but they're kind of like in a very strange situation now where they're pretending that they have things under control, but they've lost control in reality from before. And that's a whole new discussion that I'm bringing up, to be honest. But it's quite important because if the Fed is the one that's supposed to be reining in on things, I kind of think they lost the plot from COVID times, to be honest. And this is where we are. Like you ask the average person if they were better off. I mean, your grocery bills are higher; they're not coming down. And the Fed is partly to blame. So we're really going to be trusting these people to solve things? Nah, I don't think so. Gold is telling you that as well, by the way. So
Totally. You've got such a lighthearted way of putting it all, and sort of calling out the stuff like Zuckerberg and the hot mic in the meeting there, and Powell and Trump, quabbling over the bill and these sorts of things. But they're pretty sort of serious challenges all the same. Is your framing just to kind of get long real assets and partake a bit on the side with GAG, with the Golden Age and these sorts of things? Like, how do you think about it all?
Yeah, so I have a very, very simple view that I'm trying to get people's minds around because it's something that if you don't understand, you're going to blow up. So, for my sins, I'm a boomer and I've lived through 2008 crisis, I've lived through 2000, but 2008 was very memorable to me. And, I was lucky enough to be working for one of the guys from The Big Short who was a genius and, nailed the trade. And, we made a lot of money during the crash. But, the mentality of a lot of people from my generation is that they always expect a crash. And they always expect like a deflationary crash whereby equities are going to crash, bonds are going to rally. We're going to have like a price discovery in assets. They're going to buy things like 20 cents on the dollar and they're going to make money on the recovery. But that's bullshit because, my same boss at the time, who I say he was a genius, he said something very smart at that time. He said, every crisis is different. So the new crisis cannot be like the old crisis. So the new crisis cannot be like 2008. So what I'm trying to get people to understand through my writings and my memes, and usually they get it after the memes. Maybe they don't read the writings, but they read the memes. They get the memes. Is when you're in a golden age of grift with a currency debasement focus, you should be thinking not about 2008 crash. You should be thinking that at the end of the day, your currency is going to be worthless. So you have like the left tail and you have the right tail. You have to be thinking about different scenarios. You have to hedge yourself against different scenarios. So you could, like, there is a small chance you get like a 2000 crash because of an AI capex bubble. But there's also a chance that you get like a Zimbabwe, Argentina stock market whereby you just debase your currency and you have to be in real assets. So the way I approach my portfolio construction is this. I tell people in the golden age of grift, you need to have real assets. You have to have a barbell approach. So you need to have on one barbell, you need to have the real assets that you guys talk about all the time. All the stocks and commodities that you guys talk about, it's that barbell. Plus emerging markets, by the way, because emerging markets like Brazil, for example, they're going to be massive beneficiaries of debasement. So that's one barbell. And on the other barbell, you can just put whatever you want. You can put like, growth assets, or, you can put your golden age of grift trades that I put on. I have a lot of, you can just play around with the simple thought that if there is a debasement, you're going to have something left. If there's a crash, you're going to have something left. Because, everyone comes out and, they have a very strong view about, oh, the market is going to keep going or the market's going to crash. It's like, guys, I'm really not that smart for that shit. So basically, I just want to, like, I'm managing my own money. I just want to, at the end of the day, I want to make money and I want to survive and I want to have capital left over under all circumstances because that's what I do for a living. So I think the only sensible approach is a barbell approach. And within that barbell approach, the other way to think about it is when things are getting stretched, like now, which I think we're a very interesting turning point, and we can talk about that later. If you spend like a little bit of premium in puts, it's like a sacrifice to the market gods. So
The blood
it's
sacrifice.
like, it's a blood sacrifice. Like, you've had a good run, everything is up in your portfolio. You go to the market gods and you say, okay, I offer you this blood sacrifice, and spend like 50 bips in puts, and here you go. Be kind, be gentle.
I love hearing you talk about this barbell strategy, and of course the appeal of real assets. Given the macro backdrop, the golden age of grift is so compelling. And you brought up gold earlier, but I do note, in your own portfolio, a lack of allocation to gold specifically. I know you're long platinum, but why? Like,
Yeah.
why? Like, you speak the language of the gold bulls, who are in a permanent state of thinking like this, by the way, but you don't
Yeah.
have the allocation of the gold bulls.
Yeah, because I have the burden of knowledge, unfortunately. And that's why I messed up the trade. Like, I did really well with platinum this year. It was like up 50% on it. And I'm still quite bullish on it, actually. But on the gold side, it's always about, the history of your previous trades and what you lived through. So the last time I bought gold was 2008, when, I saw my boss just go all in gold. And I was so afraid about the world that I actually went and I put like a third of my money, like I put a third of all my assets actually in physical gold. Like, I went and bought bars and put them in a safe. And then fast forward, like, that was at 950. And fast forward like a year or two later, gold was at 1500. I'm like, oh, that's awesome. Okay, fine. So I just went, cashed out my bars. I saw gold run up to 1800. And I felt, I'm such an idiot. Because all my friends and colleagues, they just kept writing it. And then that thing crashed back to 900. Oh, and by the way, the miners did so badly at that point because, you know, I remember I had a lot of friends who were buying the miners. And I was like, oh, there you go. Gold is like Buffett was right. Like gold, you just buy it when you're really afraid of the world and you don't bother again. So I made good money. Like, I mean, look, I was young and I put a pretty big bet, so it was good money for me. And I never bought physical again. And, you know, since then I've been telling myself like, you only really want to buy gold when you want to buy it physical. That's the time you really want to be buying gold. And to be honest, I think we kind of had that moment a year ago, or sorry, a few years ago, when you know, the geopolitics changed so much. Maybe actually from Ukraine, actually, when you're like, you probably want to own physical gold here. And I think that was a turning point that I should have just woken up and just done it. But you know, the way I see it, though, just to give me a break, is I kind of just bundle everything together. Like I don't feel I need to own gold, but I feel like I need to own real assets. So, for example, you know, I bundle these things. You know, I have miners that have done as well. You know, I have other metals that have done as well as gold. So I always make sure I have that allocation, and that's something I don't touch. I want to have like the minimum should be like 20% with all these things. Because I know like this guy Gunlach came out and said, oh, you should put 25% of your money in gold. It's like, dude, thank you so much. Like, thank you so much for the lesson in hindsight and back trading. 25%, great. That's not how I see it. Like, put 25% in real assets and you'll feel better. Like 5% gold, 5% platinum, 5% copper, 5% whatever. Something, you know, something in Australia that's safe versus other parts of the world. I think the real asset category should be quite broader. I mean, you know, whenever I bring it up, like actually it's quite funny because like you just asked me, why don't I own gold? I get crypto guys asking me, you've given this lecture about real assets, why don't you own Bitcoin? And I'm like, because I don't need to. I own other stuff that I like, but that trade the same. In fact, I mean, Platinum outperformed Bitcoin by like 3 times this year, but no one talks about it, right? So, you know, stuff like that, I think there's always a narrative attached to it as well, right? The Bitcoin guys are just so persuasive. Like the crypto guys are so persuasive. And you're like, why are you guys trying so hard? Oh, because you're trying to pump your shit. Okay, I get it. Whereas real asset guys like, you know, the gold bugs, the platinum bugs, the silver bugs, like, you're not really trying to pump anything because it's been there for like 5,000 years. And you know, there's the occasional gold conference that they'll go, you know, hold hands and sing Kumbaya, but, you know, that's not really what's driving the price of gold. so, so, you know, my point is like different people have a different idea about real assets. And I actually do, you know, I'm sympathetic to the idea of Bitcoin being a real asset as well nowadays for for digital nomads. And there's actually like there's a whole argument why you should include some Bitcoin in the real asset bucket. And I think that argument goes back to my thinking about, my fear in 2008 that I had to go out and buy bars. Like, why did I have to go and buy gold bars? I was actually afraid of the banks because I was short all the banks. And I'm like, oh shit, the banks are going to blow up. I might as well just hold gold bars. So now fast forward to today, we don't have the fear of the banks blowing up, but we have the fear of the governments blowing up, and we have the fear of actually getting debanked. And what do I mean by that? Like the UK arrests people for tweeting the wrong shit. So, you know, imagine if I tweet out the wrong shit and the UK comes to me and says, oh, I'm going to seize your house in the UK. Well, you can seize my house in the UK, but you're not going to seize my Bitcoin, kind of thing. So there is, I think, that extra element that we have to be thinking now. And that's why, you know, I'm not against some digital asset allocation from a safety perspective, but, you know, of course, that just depends on a person, on a personal basis.
Shrub's got his portfolio of real assets and his whole barbell approach. And if you're thinking about a barbell approach and real assets, well, I know a conference that we're going to in Sydney next month, very shortly. There'll be a lot of real assets floating around.
That's it, mate. October 21st to October 23rd, IMARC in Sydney. Get your tickets, details in the show notes. If you want to buy real assets, you need to learn about mining companies and commodities. Why not speak with other investors, speak with the companies themselves, speak with the service providers? No better way to get up to speed.
Why are you pumped to go to IMARC, JD?
Mate, I'm pumped to go to Sydney, your favourite city. I'm pumped to speak with a bunch of people. We've already slotted in some cool interviews we're going to do, mate. There's a lot of reasons to get excited. How about yourself?
We're keen to see you there, Money Miners. If you're at IMARC joining us, come say g'day to us.
Get your tickets to IMARC today. One of the funniest things you've written this year was you sort of made commentary about catching up with a doctor in Cyprus who brings up a biotech, which is an Ethereum sort of holding unit type thing. And to tie that in with something you said earlier, it seems like we're at some sort of turning point type thing. So how do you think about the really sort of recent run up in things like Ethereum and other kind of speckies out there?
Yeah. So that was a really funny story because I was sitting down with this doctor, 75 years old, very respected, one of the best in his fields. And he starts talking about the stock. He starts asking me about the stock market, and then I ask him, it's like, did you buy any biotech? Because I'm actually, I love investing in biotech, and I was hoping for like this revelation, like hearing from a specialist about any new inventions or progress in biotech. And he says, oh yeah, I just bought this biotech company because they're gonna switch to becoming an Ethereum treasury holding company. And I'm like, oh my God, this is a 75-year-old doctor. He's investing in a biotech company because they're going to be buying Ethereum. Okay, this is it. That's kind of done. So I use this little anecdotes as a benchmark of how invested people are in these things. Anecdotally, by the way, I don't know that many people who are long gold in size. So that's interesting. Like all these boomers, like this guy doesn't own gold, for example, doesn't own miners, but he owns a stupid Ethereum treasury company. So I think this trade is like, these treasury companies are fundamentally stupid. People are going to, I mean, the underlying might do okay, but there is zero reason for these things to trade at a premium to NAV. And I'm just glad we're doing this conversation in Money of Mine, because you guys are familiar with the yeah, exactly, with the uranium trusts. So here you have like the uranium trusts, and they were trading at a big discount, and we're talking about a scarce resource that is actually has a deficit. So imagine uranium is trading at a deficit, and the spot is trading at a discount. But suddenly you have all these shit coins getting put in treasury companies, and they all expect it to trade at a premium so they can issue more shares to the monkeys so they can buy more of the worthless coins. And we're talking about like a lot of these coins getting circulated. I mean, it's kind of like a stupid thing that is going to correct itself down the line. But it also tells you that we are at a turning point. And we're seeing some nascent signs. It's a bit like 2021. Remember, where everyone was long all the crap and no one was long like the real stuff. And then there was like this big wave that just came and just, gave this massive rotation out of Ponzi into real assets. Like in this case, it's a bit more nuanced because we are in the golden age of grift. But it tells you that there is a lot of capital still that is getting allocated. And that capital, hopefully it ends up in some of the stuff we own, right? I mean, we already had some very interesting developments in commodities this year with, I mean, the most interesting development for me was when the US government pretty much backstopped MP materials, right? So from that point, you created like a completely different theme in commodities. I mean, as someone else smarter than me framed it, he said, in the past, we used to invest in commodities that the Chinese were short of. and now we should be investing in commodities that the US is short of. That's actually like a really insightful comment that you can just create a whole portfolio out of this. So you basically, the moment that the US is panicking about their own shortfalls, well, you should be looking at projects in the US that address those shortfalls, and that could benefit from any backstop from the government. Like, this is actually one thing. This is one of the benefit. Sorry, this is one of the good things of the golden age of grift, that the U.S. government is doing the right thing in this point, and this is something that they should keep going, and this is something that they should be spending money on, because this is addressing a major imbalance that's been building on over the last like 20, 30 years. Right. I mean, classic example, all these, the tungsten mines that they closed 30 years ago, or the tin mines. Like, remember they used to have like tin mines in the US? Not anymore. So you have all these things that need to be addressed. And this is something that's going to take time. And this is actually quite bullish for very niche parts of the market. So I'm not going to say that it's like a, super bullish for, global commodity market, but it's very bullish for certain producers in the US.
I read your article when you published an update on commodities, like with explicit reference to that MP Materials deal, and your thought process as you're trying to brainstorm, well, what's next? What metals is the US short of that could be next? You rattle through the likes of antimony, tin, copper.
Yeah.
Has your thinking evolved on that front, on what could be next in predicting the kind of?
Yeah. So I think like the rare earths is going to keep going, because this was like step one, but they still need to address, the heavy rare earths and, just complete the whole supply chain, because, there's different elements to the supply chain. Like, you can guarantee the price, can put a floor on the price, but you also need like the refining and everything around it, or the recycling element to it. That's number one. Then number two, I'm actually surprised they haven't done it with antimony. I mean, with antimony, they've given them some grants, but that's also a critical part they have to address. Tungsten, I think, is an easy one. I mean, there's a couple of projects there that they're supporting. Copper, they might actually build the road of Trilogy, right? I mean, they've been trying to build that road since whenever. So that's actually, I would love to see that road get built, and that would be like a major achievement. So I think the easy ones are like rare earths, tungsten, antimony. Make some progress with key projects like copper. Stuff like Northern Dynasty, I still think they're never going to get built. For the reason being, building a copper mine like Trilogy, literally you just have to make a few people shut up and you just build a road and you're done. Whereas in the case of Northern Dynasty, I think it's way too much. Like, it takes a lot to get someone to build that mine, because I think that mine can only be built by like Rio Tinto or BHP, and they're not going to touch it. It's just too difficult. I mean, there are environmental risks to it. I mean, I've invested in that thing like 15 years ago, and it was like evident that it's too risky. So I think we're going to draw a line with like simple stuff, basically things that make common sense. I think tungsten, antimony makes common sense. Trilogy makes common sense. The rare earths, they make common sense. And I think the government should really be putting money in all these things, like aggressively. Speeding up permits for smaller copper projects, definitely. And the other thing I'm a bit surprised is they should, I mean, this trade war was too aggressive, because they should have been building like alliances with other neighboring commodity producers, like with Canada, for example. Like, it was an easy win to create alliances with Canada for the supply of critical metals. I mean, the one thing that I'm actually still super bullish on that no one talks about and no one has is tin.
Now we talk
I mean,
about
this
it.
is just, yeah, I know you guys talk about it. So like, so we're kind of like the minority of like 10 people that talk about tin, but this is actually quite incredible. we're so niche. We're like the niche of the niche. we're like
I'm pumped
we're
about
like
tin.
you know.
I'm so pumped about
Sorry.
tin. I'm so pumped about tin.
Oh, there you go. I'm in the right. I'm glad I'm in the right podcast because I'm super excited. I'll tell you why. Because I see people like pump all these. Okay, I get the story with antimony and tungsten. You know, these are very credible stories. But you know, they're also up like 10 times from the lows. And you know, these projects now make sense only with a floor. Like the government has to give them a floor to justify the investment. Otherwise, no one in their right mind is going to go out and build a tungsten mine based on the spot price. Like you just wouldn't do that because you know the spot price is going to go down 50% in the next few years when the new projects come in from any country ending with stan. Right, there's a lot of projects in these countries with stans that Tajikistan, Kazakhstan, and all these ones. So you know you can just get new supply from these. But in the case of tin, like the the deficit is so obvious, the supply side is so bad, the demand side is just going through the roof, and no one cares about it. And it's actually so quiet that people are not even talking about it as a critical metal, as if you can have your semiconductors and your wonderful AI without tin. I mean, it's actually like a beautiful setup. Remains like you know, I'm still bullish in your. It's actually the only stock I own in Australia. Still, I've owned it for a few years. Is Metals X.
Me
Like,
too. Ding,
I
ding,
just
ding.
refuse to sell it. I bought it like 15, 20 cents. I'm like not selling that thing. Um,
Yeah.
it's just insane. Like there is. Have you seen a new tin mine? Like every new tin project I see is like it's just crap. There's nothing in there.
Yeah, undoubtedly, Alpha Min is a much better project, but you have to be comfortable
Oh, sure.
in a different jurisdiction. And in the case of Metals X, ding ding ding, I should disclose I own some too. I'm pretty. Like I've got no confirmation of this, but I'm pretty sure they're land banking, like the pipeline of development projects. That's what these 20% stakes are in the tin
Yeah,
juniors.
I agree.
Like why do you have multiple 20% plus stakes in tin juniors unless it's a land banking strategy? So like that further complicates your supply story if the West's other development opportunities don't actually have a feasible pathway to development in the near term.
I agree. I don't think it's that bad what they're doing.
Yeah,
They're just laying claim on all these little projects. I
yeah,
mean, look, Alphamin is a great project for sure, but you know, I used to own it, by the way. Um, I just can't be bothered to look at news about Rwanda and the DRC. I just can't be bothered. So that's why I'm out of it. But great project, sure, but I just rather just run with Metals X. And I was hoping secretly that they would take out their JV partner and just be done with it. Hopefully that happens down the line. If that happens, that stock is just going to go like 2-3x because it just cleans up the whole thing. But you know, going back to the example, like Metals X is trading at what, like 2-3 times EBITDA nowadays. So you basically have a critical metal, the only Western company doing it, trading at 2-3 times EBITDA. No one gives a shit because you know, let's chase something else that's shiny and Trump said it. But, you know, if Trump says tin, it's going to go up 100%. But he doesn't say tin. He says like rare earths. So let's just buy rare earths.
Your point on alienating Canada, despite them being a resources ally, is super interesting as well because they're really cozying up to the DRC on that kind of topic. They're trying pretty hard to settle down what's happening in the sort of war-torn part of the country, talking about starting this new fund where people are going to invest, targeting places like the DRC. So the geopolitical kind of strategy is interesting to piece together.
Yeah. Look, I think the DRC has a great story with the US, and it does make a lot of sense. And in fact, when I mean, the conflict between Rwanda and the DRC ended with US intervention, which was really interesting and actually very bullish for Alphamin. So that's why I'm not against Alphamin. But having said that, you know, the area always boils into something else. So, for example, there was a CIA-led coup attempt in the DRC, like just recently, actually, which failed. And in the DRC, you know, I do know for a fact that there's a lot of you remember Wagner, the Russian mercenaries? Yeah, so there's a lot of Russian mercenaries who operate in the DRC for a very simple reason. Like these guys were fighting against Ukraine, and these guys are vagabonds. They're out in the DRC trying to secure mines. So, you know, it's not without risk. Now, if the US thinks tin is so important, they'll probably go and secure they can secure Alpha Min in like one day, right? But why bother when I can just buy Metals X? I mean, sorry. Kind of just seeing it that way. But I'm not against it. Like I said, I'm just not against it. I'm just a little bit older, and I just don't want to bother reading news about Rwanda.
You've written a bit about a potential resolution between Ukraine and Russia as well. Curious,
Yeah.
Honing in on the commodities aspect and perhaps touching on inflation as well, how you think that could play out if we see a resolution there in the near term.
Yeah. So I've actually I was expecting some progress, and I did get like that run up to it. And the more it drags, I think the more pessimistic I'm getting in what it. I'll tell you where I am and what could happen. So, unfortunately, right now, Putin has created a wartime economy. And once you create a wartime economy, whereby your whole economy depends on building weapons, recruiting young men to send to war, everything around the economy revolves around supplying the war machine. It's very difficult, you as an autocrat, to just suddenly come out and say, oh, we're going to have peace now. Okay, say you have peace. Well, what now? What's going to happen to your economy? Like those factories where you make your tanks, what are they going to do now? You're going to switch to making AI chips? You can't even program. Like you're a donkey. So like these guys are just, no offense to them, but they've turned into like 1984 type monkeys, whereby the machine is just feeding the war. And if you want to keep control of the country, you can't really stop that war. It becomes like the endless war, like 1984. It just keeps going. And unfortunately, this is where we are with Russia right now. It's very sad because I would like this to end. So that's why I'm kind of negative to it. And also there's incentives from other places, like China kind of benefits from the tension because they're getting cheap energy at the same time. And now they're going to have this pipeline, the gas pipeline as well, which was a big win for Xi. So I'm kind of pessimistic on having progress. That's number one. But number two, if there is progress and if there's a ceasefire, I mean, certain areas could get impacted, but I mean, the supply chains have changed so much to accommodate, like, product has found its way around all these sanctions. Like, no one can say that Russian oil isn't getting pumped and exported. It is. I mean, it's getting sent to India and it's getting sent to China. Or Russian palladium. I mean, Russian palladium is still finding its way to Europe. So I actually don't think it's going to make that. It will have some impact, but it's not going to be huge. Where it will make some impact is in the general inflation top line, because wars are inflationary. So all these supply chain work-throughs, once they come out, you will have like a deflationary effect naturally. Also, just on the cause of spending all this money, well, you're going to spend less money, which is deflationary by itself. Like, NATO is going to spending 5% of their GDP or something stupid. So once you have all these general spending around the war machine just come down, well, that's going to be it will be beneficial for lower inflation. But it remains to be seen. Like even Trump said himself, like he was disappointed with Putin. So I don't know. More sanctions are not going to do much, I think.
I'd love to hear your Brazil thesis, the Shrub. Tell me why Brazil is going to be a massive beneficiary of debasement.
Yeah. So the thing with Brazil, I wrote about Brazil about a year ago. And I got so many emails from very good readers based in Brazil saying, I'm so glad you wrote about Brazil because everyone hates it, including everyone here in Brazil. We all hate Brazil and no one owns Brazil. And I'm like, oh, music to my ears. Even the
Perfect.
locals hate Brazil. And, fast forward now, the market's up 30%. But I actually think there's more to go because, again, like one of my smart Brazilian readers, he actually did point this to me. He said, look, when it goes, it doesn't go up 20, 30. It goes up 100. So with the knowledge of my subscribers, I'm building up on that and just expanding, saying, look, we're up 30, but this thing can actually do way more. For a very simple reason. Here's a setup. Number one, rates. I'll start with the macro. So the macro is quite simple. So rates in Brazil are like 15%. So they're like the highest rates in the emerging to developing world, like to a serious country, let's put it this way. Their inflation is like between 3 and 5. So if you compare to the US, which has like inflation of 3 and rates at 4, you're like, oh shit, okay, so Brazil has like real rates of like 10 versus the US has real rates of like 1.5. So that's one. So rates can only come down. That's number one. This is very important because all the money, and again, I got this feedback from my Brazilian readers. The Brazilian fund industry got decimated because with rates at 15, all the pension funds and asset allocators took the money out of equities and just parked it in Brazilian government paper. That's why no one owns Brazilian equities. It's really simple. It's like those things we were taught in school, which is called like crowding out. When the public sector crowds out the private sector, which they thought was going to happen in the US. Well, it's happened in Brazil, where all the money comes out and goes into paper that pays them 15%. Because why would you own equities that don't go up 15% a year? Sorry, risk-free, by the way. So that's the macro setup. That's number one. Number two is the market is actually really cheap. We're still way below the COVID. We just bounced off like the COVID lows. So the market is actually quite cheap, and we're like, it's trading at like 10 times P or something. I forgot what the last last P number is, but it's like if it's not 10, it's 11 or 12. So like we're talking about like really low P multiples. Cash flowing, going back to the real asset, it's actually like a real asset economy in the sense you see the companies they have, it's Vale, real assets, Petrobras, real assets. They have the banks, which are actually like really well run. They have the commodities. So have a lot of ag. So their Brazilian real is backed by agriculture as well. So it fits in the real world, real asset category, owning Brazil versus like a Ponzi market. Let's put it this way. So that's that on the valuation. And then lastly, so that's 2. 3, the currency itself has, it was at the weakest level it's ever been. So I believe, I believe in like a dollar bear market. So obviously the Brazilian real would be a major beneficiary from a dollar bear market, especially if rates now are coming down in the US. So you have the kicker from the currency. And then lastly, and more importantly, the whole market has been capped by Lula. And Lula has been pretty bad. I mean, he's been acting like a socialist, which he is, but more to the left side. So he's alienated the business people, and he's been pretty bad for the economy as well, just giving handouts to the poor, screwing the business class, and the entrepreneurs. So people were put off from investing in Brazil because of Lula, and that was like the biggest pushback I got. And then now we have a very important catalyst. We have elections in October 2026. So we have a chance for a change. And with all these good things that I just told you, we now have a catalyst. And the biggest pushback I was getting was, when I laid out the thesis was, but the catalyst is like too far away. To which I was replying, well, do you want to buy it when it's cheap, or do you want to buy it when it's expensive? Because once you get close to the catalyst, every monkey is going to be buying Brazil. So, fast forward like 8-9 months later, market's up 30%. The catalyst is getting closer, and there's still way more to it. If the catalyst gets actually, like if Lula gets out, I think the market's going to just keep going, because you have a, I'm not going to say melee type potential, but you have a right-wing pro-business candidate that could have like an Argentina times 10 in terms of size catalyst. And at the same time, no one owns the market. So I still love the setup. I think like, when people ask me for like lazy trades, like I always get like asked, what would you buy? What would you sell everything? I'm like, dude, the last thing I'm going to sell is Brazil. Like I have just no interest in selling Brazil. I don't care what you think about the outlook in the world. Like if you think this S&P is going to crash 50%, I don't care. Like just buy put on the S&P, and I'm just going to keep Brazil. Because it's there. I mean, it's obvious. Like, I don't want to sell cheap stuff, and especially when there's like a clean catalyst and a long story ahead of it.
Why buy the index rather than like specific names within there?
Because I'll tell you why. There's a few reasons. One, I can go big on the index without overthinking it. It reduces the risk of messing it up. So and then it's like I tell you, do you want to buy the S&P on 12 times PE, or do you want to buy, Microsoft on 20 times earnings and, Exxon at 10? And you're going to be like, well, I probably should just buy the S&P and not overthink about it, kind of thing. I don't know. I mean, weird example, but, you can get torquey things. You can get smaller companies, or you can buy Vale, to be honest. I mean, Vale is super cheap.
Super cheap.
But yeah, it's super cheap. So, but I was just thinking, you know what? I'll just buy the EWZ ETF. I'll supercharge it with calls on top, because because the index allows you to buy calls cheaply. So that's what I did. I just went like index, good size, calls on top, good size. So that gives me like a pretty good leverage. And I just, keep it simple, Shrub, Kiss again. I know I should be building like a complicated basket, but I'm like, you know what? I'm going to end up with the index, because, you're going to end up with like Vale is 10%, Petrobras 10%, Itaú 10%. So you're like, oh, you know what? Just keep it simple. Just buy the index in size and just be done with it.
What about all the drama of Bolsonaro and everything in the last kind of week or two? Does it give you any sort of pause?
Yeah, it's actually pretty good, I think, because so Bolsonaro got sentenced. Well, they're going to appeal that, but in reality, the threat to the bull case for me was actually Bolsonaro running for president against Lula. Because if there's one person that would lose against Lula, like I think a pet rock, a Shrub would probably win against Lula at this point. But the only person that could lose from Lula would be Bolsonaro. Because Bolsonaro has like he's got a checkered history. Some people don't actually like him for a good reason. So I think it's good that they go after him and just prevent him from running, because that means we're going to get a different candidate. And that different candidate would probably be like Tarcísio, who's the mayor of São Paulo. Was a really good guy. So I think it's actually a positive catalyst not to have Bolsonaro. Like, once they confirm Bolsonaro not running, I think it's a pretty good catalyst for us, because it just removes the one guy that could lose against Lula.
The way you describe the allocation towards Brazil, I do wonder why you've got maybe a different approach with platinum, right? Like, and this is a kind of a question we've contested with ourselves. Like, we've been picking up exposure to PGM, like the PGM trade, for a period of time, and it's like, what's the best approach? Is it to buy a basket where you effectively can't stuff up? It's hard to be right about the trade and then wrong about your outcome.
Or just buy physical because you're so scared of South Africa.
Physical. And
Yeah.
in your case, you're you got a very buoyant outlook on platinum, or have, and you've expressed the latest innings of that trade, Valterra. Why Valterra specifically, rather than finding a basket?
I kind of like, I paper-handed my Valterra trade. I have to admit, like, it's one of the things I'm annoyed about, because I was so I got in Valterra a good level, so I made money on it. Great. So I was waiting for the demerger of Anglo. So I was just thinking of Valterra as like a event trade, because Anglo likes to sell cheap, right? That's what Anglo does. So when Anglo sold Thangela, they just sold it at the lows, and the thing went up like 10 times. So I'm like, you know what? When Anglo sells Valterra, it's probably going to be the low in PGMs. So, they gave us a really good entry on Valterra. So that was great. And then, had a good run, sold it. I was expecting their placing to come out at a discount, which it did, but they kind of ramped it after the discount. But, my thinking was it's a well-run company. It's cheaper than the rest. It's the biggest producer. So, just again, keep it simple and do that. But in reality, I'll tell you what the right strategy is. I've thought about it a lot. And I think the right strategy is actually buy physical and just keep it. And probably buy bars. I mean, the problem with bars is that you have to pay like VAT around them. So that's the problem. Otherwise,
we've looked at that.
Because have you looked at it? Yeah. So same thing in Australia, right?
Same down here. It's a shocker. It's 10% either side. Yeah.
Yeah, it was even more here. I think it was like 15 plus. So you pay full VAT on it, which is kind of stupid, because if there's one thing you want to buy physical right now, I think it's actually platinum. And the other good thing about physical, like when you buy physical, you don't think about it. You don't see the mark to market. You just say, you know what? It's mine. It's like a house. And that's it. So I think, the problem with these PGM equities, and by the way, I've invested in them since 2008. I remember Lonmin, for example. I don't know if you remember companies like that. I mean, these were really shitty companies, like really bad. And I mean, even from the listed ones, like SBSW, we made money out of it, but I mean, it's a tough, these are tough stocks. And Valterra was good because it didn't have debt. Impala is good because it doesn't have debt. But, ultimately, making the numbers for these companies is quite difficult because of all the byproducts. Like, let's put it this way. You might get the price of platinum right, but you might get the price of palladium wrong, and rhodium might collapse. So you're expecting them to make money, but they actually lost money. So they're not like as clean as a gold company, for example, where there's the price of gold and that's it, that's their margin. So, and then you have the South Africa risk, which just makes everything more complicated. So if you just look at the supply and demand of platinum, supply is crap. I mean, no one's producing more platinum, and the supply is coming now out of recycled material and like, inventories and stuff like that, which, can easily go the other way. So that's that. And then the demand side is actually being quite okay. So if you want to just hedge geopolitically and just hedge the whole supply side remaining crap, which it will, I think you just buy physical platinum and forget about it. Like, become like the gold bugs. Like if the gold bugs are storing gold bars, why shouldn't you, as a platinum bug, store some platinum bars? I mean, I would love to hear someone, come up with like a tax efficient way of doing it. But I guess like the ETF is probably the easiest way at the end of the day. I mean, I was doing it with futures, but probably ETF is better to just avoid the rolls and be done with it.
Yeah, I think so. You mentioned Palladium there as well. How do you sort of think about Palladium?
I mean, see, Palladium is a tough one. Like I never liked Palladium, but again, it's a burden of history because, I remember Palladium used to be at like $300 because automotive companies were using platinum for catalytic converters, and then the platinum became so expensive they just switched to Palladium, which pushed up the price of Palladium from 300 to like 2,000. and it became more expensive than platinum. But they never switched back to platinum because there's actually way more supply of palladium. And this is one metal that actually Russia is a big producer of. So having said that, the Norilsk mines that produce palladium are really crap. Like they really just haven't invested anything there for the last few decades. So basically, like the Russians, they don't like to invest; they just like to take, as you guys know. So they've been just draining the money, getting it out of Russia, putting it in, the south of France in villas instead of reinvesting in their mines. So I actually think those palladium mines are not going to be as good as people think. But that said, I'm a platinum maxi versus caring too much about palladium, because I see platinum as a precious metal, and I see palladium as an industrial metal. So if I'm gonna store some, like, okay, the simple example I get is like you go to your wife or girlfriend, and you just say, "I bought you this beautiful palladium ring." She's gonna just slap you, like, "What? Palladium ring?" Like, you're only gonna give like a platinum ring to someone. You're not gonna give like a palladium ring. I mean, what is that? So
Are you actually going to give a platinum ring? Is that a thing? Like,
of course, I gave my wife a platinum ring.
did you?
I think in the sort of, the public
Yeah.
consciousness, like the tiers, you have bronze, silver, gold, platinum, you have a platinum card, all these things. Platinum's at the top.
Yeah,
Yeah.
platinum's at the top.
Yeah, but it's always
So
it's
there was
always
actually,
a digital embodiment rather than a physical embodiment.
Yeah. So it was actually funny factoid, but the Platinum Association partnered with De Beers back in the 2000s to make a marketing campaign in China that if you want to get engaged, you should be offering a platinum ring with a diamond on top. So it became like, the top, the aspirational goal for a proposal in China would be like a platinum ring with a diamond on top, thanks to a De Beers campaign with the Platinum Association in China.
Get a lab grown diamond these days, just plonked on
Yeah,
top.
exactly.
What do you
that's
think?
a big discussion by itself, actually.
Before we jump into that one, though, how do you think, because you're a sort of trader by mentality, sort of Shrub, how do you think about these ratios? You've obviously mentioned there you think of platinum as a precious. We hear a lot of people, if we go back to what you referenced there, 2008 sort of time frame, the ratio of platinum to gold, completely different. Do you pay much attention to that?
Yeah, of course. I lost a lot of money doing that, so that's good for bringing it up. So when I first invested in platinum, it was like 2-to-1 to gold. Like the first time I did analysis on platinum, then at some point, I actually remember buying platinum at a 30% discount to gold, and I got stopped out like 5% lower or something. It went from like 30% discount to like 35, and I think I stopped it out like ages. I'm talking about like 10 years plus. And then I thought it in a different way, which was more helpful. And that was about a year ago when I went big in platinum. Platinum was trading at like 950 or something. It was trading like the 900s. Platinum was in the 900s. And gold was breaking out in the 2000s, but it was breaking out like 2,500 or something. And I thought about it differently at that point, and that's what really helped me. I was like, look, platinum is trading at 30, 35 cents on the dollar to gold. I don't need to short gold. I just need to buy platinum. Because, I'm seeing there's a bull case for gold. It's obvious, like the trend is there, the thesis is there, the macro is there. So I might as well just buy the precious metal that's trading at like 30 cents on the dollar. Just see that as a floor. So I think the ratio, basically, what I'm trying to say is the ratio is very helpful to just guide you for the investment decision versus you should never, ever trade the ratio itself. Just don't trade the ratio. It's stupid. Like, just don't do it. Like anyone hearing this, don't trade ratios of commodities. Inherently stupid. Leave that to other people. Yeah, just keep it simple. I think it should be a marker. I think it should be a guideline that basically, like, when you buy platinum at 30 cents on the dollar to gold, it's a good investment and you should just buy it. Simple as that. And you can make the same argument, by the way, with oil versus gold, copper versus gold. Like, these things are very good markers to just see where, where the lows are. Actually, I would love to see where the oil versus gold is right now. It's probably like at the lowest or something.
Yeah, that one's super out of whack. Speaking of gold as well, Noble is one of the names in that sort of portfolio you've got, and that whole offshore services, be it Valaris, Noble, all these guys, they're really interesting and they're super unloved at the moment. So curious to hear you to sort of riff on why you hold a small sort of position in that.
Yeah, it's kind of like, it's one of those things, like, I felt like it bottomed out. Like, I owned it from higher and then I felt it bottomed out in the 20s, so I had to buy more. Then it went up to trim, but I kept that position because it's part of the real asset portfolio. Like, there aren't that many rigs. The number of rigs around the world is still the same. So it's, again, a supply side issue. Like, the supply of rigs is still there. The rates are kind of okay. They're making good money. So you're kind of getting like a levered play on the oil price if the oil price actually ever goes up again. But at the same time, the offshore break-evens are pretty low right now, so in the 30s. So I think the offshore industry is going to be okay regardless. So that's kind of why I like the offshore oil services versus anything else. Like, I don't touch shale or anything like that. But on the offshore side, if you think about it, if your break-evens are 30, you have a pretty big margin of safety for all these projects to get done. Versus shale, that's number one. And number two is, well, you only have X number of rigs. So that's supportive for the rates itself. And, like, you remember, like, 2 years ago, everyone loved these offshore drillers. Like, it was like the best thing since sliced bread. And now no one talks about them, while they're kind of like boomery stocks. Like, Noble pays like a 6 to 8% dividend, just chugging along. So kind of hate to say it, but it kind of like paid to wait until there's like one of those things, right?
Just boring stuff, 6 to 8%, just hanging
Yeah,
around.
nowadays, like 6 to 8% is like what a Ponzi does on a daily basis, but it is what it is.
Yeah, absolutely.
Ponzi's. The rolling Ponzi thesis that
the rolling Ponzi thesis.
You popularized when we, wow.
I mean, dude, the rolling Ponzi thesis, I'll say it now on air. I was going to write a piece on it, but it's an interesting one. So I came up with the rolling Ponzi thesis like a year ago. It was before an Nvidia quantum conference. So I said, I'm going to write a thesis that's so stupid. I said, like, this thesis is stupid, but it's so stupid it might work. So there was an Nvidia quantum conference like a few weeks later. So Nvidia was going to present about quantum computers and all that crap. So I was like, well, why don't we just buy calls on all these quantum computing stocks like IONQ and some other smaller crap, and just buy calls into the conference. And those calls ended up going up like 4 or 5 times, and the small stocks, IONQ doubled, so the call went up like 5 times or something. And then the small quantum stocks went up like 2-3x into the conference. And I'm like, oh, there you go. The rolling Ponzi thesis has been confirmed. Like, people just love to buy the Ponzis, and they just run into them. And I did the same with the SMRs, so like Oklos and Oklo and Newscape. But here's the interesting part. I thought those quantum stocks would actually deflate afterwards, which they did. But then they took another life of their own. So IONQ, I think I sold it like when it was like 6 billion company. Like, it was a 6 billion company, dude. Like, it was still like, it's still insane for something that makes no money, right? So I checked yesterday, and it's a 22 billion company, so it went up 3x. And then I checked these smaller ones that I made like 2-3x my money on that. They went up another 10 times. And I was like, oh my God, this quantum Ponzi's and all these SMR Ponzi's and all these things, like, they were rolling Ponzi's for the first few months. So, like, they went up, then they went down, but then they got a life of their own, and it just became like they gained critical mass to the point where now they're like IONQ 20 billion, QBTS 8 billion, Rigetti 8 billion. So, put them together, you're talking about like 36 billion worth of market cap in 3 companies that produce no revenues. And I'm like, dude, 36 billion is pretty much like the whole critical metals industry. That's
Don't say it.
I know. I know.
That is wild.
Yeah.
Yeah, I mean, you chucked
It is
in the
wild,
line.
yeah.
You chucked
is
in the
wild.
line in one of them. Valuation doesn't matter. You wrote it somewhere in one of
Oh,
your
it doesn't matter.
pieces.
Yeah, valuation doesn't matter. It doesn't matter. Like, and that's coming from someone who grew up like as an investment banker, as a fundamental analyst using spreadsheets and trading it based on multiples and that stuff. One thing I have concluded that thankfully a few years ago, valuation does not matter. And these quantum stocks is actually quite an example. It's all about getting the thematic right, and just the momentum behind it. But of course, people that actually just people that whose investment thesis depends on that, they end up getting killed, by the way, just so we're clear. So for example, these companies could easily end up at zero, right, down the line. But on the way there, they could be up 10x. And that's why I'm actually really against shorting these companies. Like, I tell people, like, don't even think about shorting these companies. Like, you're either long them or you just pretend they don't exist.
It's
So-
like valuation doesn't matter until it does, though, right?
Yeah,
And
it
then-
doesn't
and then-
matter until it does.
And then it's the only thing that matters. And I mean, I actually, the reason I
Absolutely.
say that is because the 2 short positions you have right now,
Yeah.
I'm sure valuation is kind of part of that. Nvidia and Tesla.
Oh, 100%. Yeah. So that's quite funny. Like, I never short single names. I used to. I was actually I don't want to brag, but I thought I was a pretty good short seller. And the reason why I have a pretty high hit rate with shorts is because I never short. So
Yeah,
so
small
obviously I'm
sample
going to have a
size.
high hit rate
Yeah.
because I don't really do it. But I kind of like, I put 2 shorts on single names. I'll say I'll say them out loud because it's just funny by itself. But and by the way, just caveat: this is all parody, not investment advice, and you'd be stupid to be shorting stuff anyway. So I'm short like Nvidia and Tesla, and I see them as like funding shorts in the sense I don't have anything against them per se, but I just like to find these, Nvidia is 5 trillion and Tesla is like 1.5 trillion. So if I'm going to hedge my portfolio with something, just rather do it like, and I have a lot of mid caps that are doing pretty well right now. I might as well just hedge my portfolio with things that I think are like maxed out. Because if the market turns, I mean, Nvidia has a whole, I think the Nvidia bull case is like maxed out. The only people left to buy GPUs are like the Martians or something. So you can just bet against that. And then Tesla has like a whole story by itself with EV competition from everything else. Like, even here in Europe, I see more BYDs getting sold than Teslas, for example. So, but I'm like super opportunistic with shorts. Like, if they go up 5%, I'm gonna just get stopped out. So I don't really care. But yeah, my shorts are very tactical, very few. I hate doing it. Like, sometimes I even wonder why. But I'm kind of writing my trading diary. So that's why I share them. But I just wonder sometimes, like, oh man, I'm gonna write down that I shorted something. I'm gonna get like 10 hate mails. I'm gonna get like people telling me I'm an idiot, which is fine. It's okay. I'm a shrub, right? So,
From your sort of journey, you've spoken about the GFC and that point in time to where we are today. When did valuations start to not matter?
I think the big turning point was COVID. I mean, there was always like a switch out of valuation. When they started talking about like factors, when people started trading factors, that was a big change. Because once you start trading factors, valuation is not like, there is a valuation factor and there is a growth factor. And then when you start putting like AI factor, thematic factor, then you start diluting valuation by itself, valuation becomes a smaller part. But I think the real catalyst was probably COVID, because during COVID, that's when we had like the retail army really pick up, people staying home and trading. And, when people, there's an army of traders that doesn't use valuation. So that's when it got even more diluted and became self-reinforcing, because the algos are picking up the retail flow, and the retail flow is trading on the back of algos, becomes reinforcing. It's like a circle jerk in reality. And then they just run up these things to the moon, and valuation just loses control. I mean, I'll give you a few classic cases. Like Tesla lost, hasn't had valuation as a factor in its share price ever. So that's number one. Number two is like MSTR, so MicroStrategy, trading at a premium to its Bitcoin of like 200-300%. Why? There's no reason behind it. It's like the algos and the retail just took it that point. It became self-reinforcing, and it became a new reality. It's like the Matrix. Like things just become a reality. We create our own reality. It's about like, let's put it this way, and this is a dangerous thing about ChatGPT. Like it's like training ChatGPT using Reddit. Like Reddit is just a bunch of monkeys writing nonsense, right? So if you train ChatGPT on the back of nonsense, well, it's going to output you nonsense. So it's the same thing with the algos. Like the algos are training on the back of nonsense, so they output nonsense. So all these things is just create like they create a reinforcing mechanism whereby valuation gets diluted. And by the way, the biggest idiots are the ones that are using on the sell side. The biggest idiots are actually the sell side, which work backwards from the share price to get their price target. So for example, Tesla is running, say they run up Tesla to like 400 on the back of this mechanism. I said this self-reinforcing mechanism. The retail guy chasing it is actually smart. He's making money. The algo chasing it is not smart, but it's doing its job. But then the sell side analyst is going to come out and say, ooh, the $400 share price is justified if you look at a 2040 TAM of $5 trillion. And if you work backwards, it's trading on a 10 times P on a 2050 basis. So that guy is the idiot, okay? Just to be clear, because that guy is going to justify the stupidity based on fundamentals when there's no fundamentals involved. Sorry for the rant, but that's kind of like, we have to call out the idiots here, and that's the sell side.
I love the rant. How do you piece in passive flows into that? Because they've just been massive the last couple decades and just accelerating.
Yeah, look, the passive flows are a feature of the system, and you can't fight against it. That's why. That's why, when you do shorts or when you look at the index, you have to be tactical about it. Like the whole thing is like a Ponzi scheme, which is fine. You don't really want to bet against Ponzi schemes. But, it's just more money coming into the system, and that money benefits the big stocks that are part of the index. And that's why, again, it feeds in this whole reinforcing mechanism. Like Tesla's in the index, it will benefit from the index. Nvidia's in the system, in the index, it will benefit from the index. Having said that, as a fundamental or tactical trader, you probably will make more money finding the stocks outside the index or coming in and out of the index or whatever, versus just playing the passive game. I mean, I'm talking about making real money versus just a passive investment. But this passive thing also creates a lot of distortions, and this is where it gets quite exciting. Like one of my best trades was actually shorting SMCI when it entered the S&P like last year, because they just ran it into like an overvalued level, and it was a crappy company. Like people were just gloating that it's like an Nvidia type play. It was a crappy company that had issues afterwards. But the overvaluation of SMCI when it came into the index presented like a great short opportunity. I think it was like one of the very, very few shorts that I did all of last year. So, I don't like to bet against passive. I mean, I'm actually going along with passive, like happily going along and, giving thanks as we float away into to the moon. But it does give opportunities. It's, I don't want to look, I don't want to be ungrateful for the opportunities that the passive system gives. And by the way, like I was having this discussion with someone last week. He said, I have decided to stop trading altogether, and I will be allocating only in passive because it worked over the last 10 years, and it's going to keep working for the next 10 years. And I was telling him, so after all the discussions we've had all these years, that's the conclusion you came up with. And he's like, yeah. It's like, okay, great. Well, let's not talk about investing again together. Because it was like, okay, you just completely missed the whole point. But anyway, whatever. So, I'm not against passive, but I just think there's a lot of ways to skin the cat. And I think there's a lot of ways to complement a portfolio. Like, you look at Brazil versus the S&P this year. You look at platinum versus Bitcoin this year. We're talking about like 20% outperformance on both, actually, probably more, on things that no one talks about. And by the way, the one thing we didn't talk about, this guy that was telling me about passive, I told him, like, you know what your net return was this year? He says, oh yeah, 10%. It's like, no, it wasn't 10%. You made 10% on the S&P and you lost 10% on the dollar, dude. You're flat. You kind of just like ran to stay, to break even. So if you didn't have the European diversification, then you lost out. You actually are poorer this year. Like if you were just in the S&P this year, you were poorer. That's why you just have to be smart in your passive allocation. If you are in passive allocation, you have to be smart about it. You can't be like the classic Bridgewater model of like 60-40. You can't do that. You have to be like equities plus bonds if you must. Like I hate bonds, but if you must, plus commodities or something. Something, back to the barbell approach, something that will have like a barbell that will save your butt if the currency debasement plays along, which it is playing along. Like I said, like it's this year the S&P return is zero in effect, like on a dollar adjusted basis, but everyone's just cheering about it, right? So so people don't even think about it. That's how brainwashed they are, that they don't even think that this year they broke even. They just broke even. And this is going to have implications because I don't think people are ready for it. I have to admit. The golden age of grift, man. The golden age of grift. It just brainwashes people, makes them dumber. People forgot their maths. No one does maths anymore. Like you said, valuation matters eventually. But common sense matters the most.
You balance cynicism with optimism. You laugh at the grift, the shrub, but you still play the game. How do you keep from just being consumed by the absurdity?
Because our guiding light and our beacon is our motto. Once you realize it's all nonsense, it starts to make sense.
That's fantastic. I think that's a perfect spot to leave the conversation. The Shrub, it's been a pleasure. Loved having you back on. Everyone should check out your Substack. Just search The Shrub and we'll chuck it in the show notes as well. Shrubstack. Thanks a bunch for joining us. Always great to chat.
Thank you so much. It was great having you guys.
Who would have thought that a talking shrub could be so insightful?
So knowledgeable and so great to chat with. And it is all made possible thanks to our fantastic partners, mate. Sandvik Ground Support, Focus, the platform by Market Tech, and iMark. Get your tickets for the conference in late October.
Hoodaroo, money minus.
Hoodaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a disclaimer.